Hi, this is Gene Trowbridge of the law firm Trowbridge Nieh. We are syndication attorneys. We work within the securities world, and this is how you can contact us. This is our general office administration phone number, our website, and you're already on our YouTube channel. And we're happy you're here and hope that you will sign up for our YouTube channel. Today, we're going to talk about capital accounts. It's the time of the year where people start getting information from their syndication sponsor, the managing member, so that they can file their income tax returns. And what they get is a K-1. And the K-1 is a document that's sent to the taxpayer. And one of the purposes it does is it tracks the taxpayer's investment in the LLCs. So the member gets a K-1 at the end of the year, and it really tells the member what's going on. But we get a lot of questions at this time of the year from our syndicator clients and from passive investors that says, you know, I put $100,000 in this deal last June, and my K-1 comes out and says I only have an $85,000 capital account. What is that? So we thought we'd take just a few minutes to explain capital accounts. I'm the founding member of Trowbridge Nieh. I was a syndicator. I've been a lawyer now doing this work for over 30 years, combined with my 20 years of being a syndicator. I've been in this business a very long time. So understanding capital accounts for investors in LLCs. What does a capital account really do? It tracks the capital that an investor has in an LLC. And it's an IRS set of rules, and the rules, when they're applied, show up on your K-1. Every investor has a capital account that starts at 0. The capital account goes up when you make capital contributions. So if you invest $100,000, now your capital account is $100,000. In tracking your capital account goes down when you take capital out of your investment. So we started with a $100,000 capital account, and we got a $10,000 distribution. So now we're down to $90,000 on our capital account. Then as long as we're tracking things, the IRS's rules say you also have to track whether you get taxable income or taxable losses. So if you get taxable income, it increases your capital account. If you're allocated a taxable loss, it decreases your capital account. Now that goes on each and every year. Starting from 0, your capital account goes up and down depending upon the results of the investment. And the last thing that happens is there has to be a adjusting entry at the end of your investment that moves your capital account back to 0. Most of the time, we have a negative capital account when it comes up to the end, because hopefully we've taken out more in cash flow than we invested. And we have had losses going on. So both taking the capital out and having losses decreases your capital account. And so you end up with a negative capital account. And what moves your capital account back to 0? The taxable income that's going to be reported on the sale is generally what moves your capital account back to 0. Now, just as an aside, the LLC has a capital account too. It starts at 0, and then everyone's capital comes in, and then that capital account tracks all the distributions, all the taxable losses or gain, and ends up with the capital account at the end, which has to be brought back to 0. And it calculates, what happens to happen is you calculate the taxable income that has to be allocated to the company, pass through to the investors to get everyone back to zero. So both capital accounts start at zero and have to end at zero. Let's see about an example. And one of the issues is here that there's a, in an operating agreement, there's a waterfall that tells you how you get your cash distributed. But when you invest in the LLC, you buy economic interests. So an economic interest involves taxable income and taxable losses. So you'll see how these two things happen. This is a little confusing for investors, but I think this will explain it. In the discussion of cash available for distribution on the left-hand side, we would look at the cash flow that the property produces. We would set aside something for reserves, and what's left is cash for distribution. In this example, it's an 80-20 split. 80% of the cash goes to the members and 20% goes to the manager. So we have, in this example, a $550,000 cash flow from the whole project. We withhold $50,000 for reserves. Now we have $50,000 that's available to distribute to the members, and at an 80-20 split, the members get $400 and the manager gets $100. So the available cash gets split according to the percentage ownership based on economic interest. Now, let's look at a 10% member. The total NOI was $550,000. The reserves are $50,000, so there's $500,000 to invest. So a 10% member will get their share of the cash distributions, and because this is an 80-20 split, there's $400,000 to go to the members, and this member with the 10% ownership will get $40,000. That will decrease the investor's capital account by $40,000. So what's happening here? In the operations, we have to also look at the economic interest. The NOI minus the interest, minus all the cost recovery reductions, including cost segregation, gives us taxable income or loss. In our example, the NOI was $550, the interest is $350, and the cost recovery is $300. That gives us a taxable loss of $150. If the split is 80-20, the members get 80% of the taxable loss allocated to them, and the manager gets 30%. So back to our investor. The taxable loss, as we saw, was $150,000 for the whole project. $120,000 is going to be allocated to the members. And our investor was a 10% investor, gets $12,000 of the loss allocation, which is 10% of the 120. Now, we all know that taxable losses decrease your capital account. So we've had two things going on for this investor that decreases their capital account during that 1 year of holding. Now let's look at what might have happened in the whole holding period of the property. After a 5-year hold, the property sells, we pay all the bills, and we have $2 million of cash to distribute. We're still in an 80-20 split. So $1.6 million goes to the members, and 20%, which is $400,000, goes to the manager. All right. So let's look at a member. The beginning balance was zero, and then this member invested $100,000 for their 10%. If they got 12%, $12,000 loss every year for the 5-year hold, if everything stayed the same, they would have had $60,000 worth of losses, which decreases their capital account. They would have had $40,000 a year cash distribution over the 5 years, which is $200,000. And then on the sale, with $1.6 million going to the members, they would get 10% of that as a 10% owner. So their capital account goes down by $160,000. So the running total of their capital account is a negative $320,000, and the investment's over. Problem is, our capital account has to end at zero. There's no more money to distribute. We're not going to pay in any money. We've already taken into consideration taxes. So the only thing that can happen is there has to be an entry that the accountant makes to give this investor $320,000 of taxable income, which would bring their capital account back to zero. So every year the investor's getting a K1, and every year the capital account balance is changing, and at some time it's going to be negative. And that may very well prompt a call to the sponsor, say, what's happening? What's happening here? And so sponsor has to understand, it's one of the jobs of the managing member, to understand what's going on in the capital account. And that may take some discussion with the LLC's accountant. One of the things that's important is cash distribution does not equal taxable income in most cases. You can get a cash distribution and the taxable income allocation is different. In our example, the cash distribution the first year was $40,000. The taxable income was negative $12,000. I explain more about capital accounts and capital account accounting in my book, in the chapter of the IRS rules. There's quite a good example that takes you through the capital account of an investor year after year, and the capital account of the LLC year after year, and how they work together. And so that's a good chapter to study if you want more information on that. How can you get a copy of my book? You can get a copy of my book by scanning this QR code. That will get you a free PDF of the book. It will also get you into our website, and you'll be able to buy, just for the shipping charge, a hard copy of my book. So maybe you want to do that. But in any event, go to the QR code to pick up your free PDF of my book. And so this was Gene Trowbridge, spending some time on capital accounts with you. Here's our main office number. Here's our website. If you want to sign up for a consultation, just go to the website. We offer free 30-minute consultations. And while you're here, make sure you sign up for our YouTube channel, and we'll see you on the next topic. Thank you.